Good morning and welcome to the most recent edition of the Main Management Weekly Market Note. Back in the office and flying solo, I am Alex Varner, our head of research here, to kick off the Monday of the first full week of February. Our offerings, as a reminder, BuyW, TMAT, SECT, and INTL are available, continuing to remind people that they're now no trade fee on LPL for those who access us there. So yeah, great news there. On the performance side, pretty broad-based positive performance for the trailing week. For the broad indexes in the bottom left there, commodities up the most 2.9, and NASDAQ 100 and small caps down. Small caps down the most at 1.9. Year to date, though, they are still up a solid 5.5, well above the S&P and the NASDAQ, which are right above 1%. For the sector performance, we had 6 up, 4 down. Energy and communication services led the way, while consumer discretion and healthcare were down the most. Healthcare was down a bit on the kind. I think it was the benefits for either Medicare or Medicaid are not being increased, so that hurt the kind of insurer healthcare provider space on profitability. On the recession dashboard for January, this is the last January reading we'll get, but as we mentioned, we turned a couple of these to green last week or 2 weeks ago. So overall, pretty evenly split, 5 blues, 4 greens. Things are looking pretty solid on the data and macro front. The big news, kind of the headline of the week, was the FOMC meeting. Rates were kept unchanged as expected. Markets are still anticipating 2 cuts this year, likely in June and December, which would bring the Fed funds rate to 3 to 3.25% by the end of 2026. So again, that's 2 more 25 basis point calls by the end of the year. The big news out of the FOMC as well was Trump's nomination for Warsh to replace Powell. That is kind of a known entity. Markets, you saw some of the response on silver and gold and commodity space on January 30th, which I think silver entered a bear market on Friday by itself, down 28 or 30%, and gold was down almost 9.5 or 10 that day alone. To us, that's kind of indicative, or it seemed like it was more indicative of kind of repricing of institutional stuff rather than the kind of longer term commodity story super cycle that we may be entering into here. We've seen so far this year. The productivity number for Q3, the final reading, was basically unchanged from the preliminary estimate at 4.9. That's Q over Q annualized. That's the best reading since Q3 of 2023. And if you kind of take out the pandemic spikes, that's the second best reading going back to, outside of that Q3 23 reading, back to 0809. So that's a really strong figure on the Q over Q. We like to see that. The output on the right jumped by 5.4%. Also the best since Q3 of 2023. Not quite as outsized as that headline productivity, but still good to see those numbers and those productivity numbers, come in strong for Q3. Manufacturing productivity was revised up. That was one of the few components that was markedly revised higher. It finished the quarter at 3.7, up from the preliminary estimate of 3.3. That's the best in several quarters as well. You can see there also that's 3 quarters in a row of positive manufacturing productivity. First time we've had that since the early 2010s. So again, hopefully seeing this kind of productivity AI boost coming in and starting to lift this productivity number as the adoption kind of spreads out. Unit labor costs were unrevised or unchanged at 1.3. That's the lowest reading since Q3 of 2023. That's good for continued moderation in inflation. You can see there, those have been running pretty hot relative to history for a while. So to see this continue to moderate has been a good thing for the inflation story. Speaking of inflation, we got the December producer price index. These were considerably hotter than expected. Headline PPI on the left was up 0.49% month over month, and core was up an even bigger 0.66% month over month. That's on the right there. Both were well above forecasts for 0.2% increases. That monthly core reading is the second biggest since March of 2022. And on a year-over-year basis, the headline figure is basically unchanged at 295, while core moved up to 3.31. That's the highest since July of 2025. Services drove these increases, which we'll touch on the next slide, led by a rise in margins for machinery and equipment wholesaling. The concern here is that, we've got CPI and PPI and those inputs go into core PCE. Core PCE is the Fed's preferred inflation measure. And so now that you've got a lot of these line items, the weightings are a little bit different, but we know the weightings. So when you have the components, you can kind of calculate and have a pretty solid guess for core PCE. And the result of this hotter than expected PPI report is that a couple of economists, a few forecasters, think that the coming core PCE reading will be hotter than expected. So we shall see on that. But here on this slide on the left, we show services on the left and goods on the right. Services surged 0.74% month over month. That's one of the bigger readings since March of 22. And that was, as you can probably guess, primarily responsible for the headline increase. On a year-over-year basis, services PPI now up 3.22. Goods was actually down 0.04% month over month and slowed to 2.37. Food contributed to that, down 0.26, and energy down 1.43 month over month. So the good side of things is not showing up in the kind of the headline figures, while services are really driving the increases this month. The trade balance for November widened back out to minus $56.8 billion. That's a trade deficit, wider than forecast for a minus 40.9 bill reading. If you remember, that October figure was the smallest deficit since, I want to say, like 08 or 09, I think. Imports were up a solid 5% month over month, while exports were down 3.6. On the right, we show there on the year-over-year basis, imports accelerated but are still negative at minus 1.9, while exports slowed to plus 5.9. Imports were led by a jump in pharmaceutical preparations after a big drop the previous month. And then purchases of computers also increased, while exports were led by falls in non-monetary gold and aforementioned pharmaceutical preparations, as well as crude oil. Still, the point here, you can see on the right there a little bit more clear, trending up. Imports are kind of trending sideways, maybe starting to move off, while exports continue to grind higher. So trade, kind of globally, demand still out there, increasing in a pretty steady and solid manner. We got durable goods orders for November. On the left, they were up 5.33% for overall durable goods, well above forecast for a 3.7. So this is good to see. The year-over-year figure surged to 12.3% on easy comps, but that's still one of the higher readings in recent years. Orders for non-defense capital goods ex-aircraft, that's a mouthful, also known as core capital goods on the right. Those are a closely watched business spending proxy, so good to see these post 5 consecutive monthly gains, accelerating to 0.71% month over month. That 5 months in a row is the longest streak since mid-2022, and that year-over-year figure slowed to 5.49, but it was up basically 5.99 in October, and that was the highest year-over-year gain in 3 years. You can see here both of these have been kind of steady uptrends. Core capital goods in a bit longer of an uptrend that started back in 23, while the headline durable goods, which are influenced by transports, you can get big orders of aircraft, especially, that can skew that headline number, but that's been in a steady accelerating year-over-year uptrend since mid-2024. So good to see those continue to rise. Doing the opposite of rising, however, is the consumer confidence figure. Conference Board's consumer confidence index fell to 84.5. Believe it or not, that is the lowest since May of 2014. I have a hard time believing that people are actually more pessimistic than they were in the depths of the pandemic, but that's what this reading says. The President Situation Index fell to 113.7. That's the lowest since Feb 21, while expectations declined to 65.1. Not quite as extreme as the others. But basically, the release noted that mentions of tariffs, trade, politics, and the labor market rose in January, and references to health insurance and war edged higher. The labor market differential on the right, which is the delta between jobs plentiful minus jobs hard to get. So you have jobs plentiful, have a percent respondents, jobs hard to get, have a percent respondents. That's fallen to 3.1. That's the lowest ex-COVID since July of 2016. Again, look at the median there. It's not even back to the median. This thing does go in big cycles, though. So it's, you're never on the median for very long. But nonetheless, this is just continuing to normalize. I think one of the concerns here is that unemployment is rising. We haven't seen that in the weekly unemployment claims, though. Not supported by that, either initial or continuing, which have remained pretty moderate. We get a non-farm payroll number coming up this coming Friday, so we'll see there, although apparently maybe the BLS might not release it because of the government shutdown. Again, I thought we were past that, but clearly not. the powers that be have decided to, shut down again. I don't have an opinion there, but it continues to be a head scratcher as far as why the government can't figure out its spending problem or its its budget problem. But that's neither here nor there. In any case, we talk a little bit this. I put out a monthly kind of roundup. It's very informal, but basically, the sentiment numbers, this along with the Michigan sentiment, this has been kind of a note over the last couple of years, especially since COVID, where they've been structurally lower than they were before. Part of this, I think, is people are really still anchored on pre-COVID prices. 5 years ago, December of 2020, again, that was coming out of kind of the depths of it. But prices are up a lot since then. I think headline and core CPI are up double digits. Some stuff like bacon, eggs, those get headlines. They're up 50, 60, 70% in some cases for certain things. Used cars are up 20%. So people are anchored to the prices they were paying. And the government is out there saying, well, inflation is under control. It's only up 2.7. The problem is that it's 2.7 on top of another 2.7 on top of that 9% figure that we had 2 or 3 years ago. And so they're actually not declining. The prices continue to go up. It is the rate of change that slows. So people have anchored on those prices, and I think it'll take a while for that to work its way through. Certainly, there's the other methodology issue where I think fewer people are getting smaller and smaller percent of respondents. So what used to be a, call it 60 or 70% response rate has dwindled to 25 or 30. So only 1 in 4 people are picking up the phone. And even then, speaking of phone, they're not answering the phone. They're filling these out online. So we've talked on this before, talking it again. But the difference in the way that the surveys are conducted is different. It's much easier to get really angry and worked up when you're typing into a little white box in a web browser as opposed to yelling at somebody on the phone. You're much more likely to be a little bit more tempered and maybe a little bit more, and that will come across as more optimistic when you're talking to another human being on a telephone. However, if you think about leaving a Yelp review for a business you didn't like or slow service or whatever, you just wail away in that little text box. So I think the way that the survey is delivered and conducted has structurally altered the responses because it is far easier for people to be more pessimistic, just because there's no human on the other side of that conversation to kind of provide some pushback or maybe some literally level of human interaction while you were just spouting angry words into a text box and hit send and don't think about it after that. So some structural methodological deltas here kind of driving this lower. And I think, again, people are still anchored on the pre-COVID prices. Corollary to that is wages have continued to outpace. Wages are up, growing at 1% faster than inflation is. So real purchasing power continues to go into consumer pockets. Household net worth hit a new all-time high, boosted by real estate and stock prices. Consumer cash piles at a new all-time high. Retail sales spending has been solid. Q3 GDP spending was solid. We touched on that as well. So people are complaining, but they're still continuing to spend. As my daughter likes to say when we go up a long flight of stairs to our house, she goes, "I'm going to make it. I'm going to complain about it, but I'm going to do it." And that's what the consumer is doing: is they are complaining about it, complaining about the high prices, but guess what? They're still out buying. So long story short, there. Thank you for coming to my TED Talk. Don't bet against the American consumer. We see no reason to do that thus far in 2026. We're only a month in, but still, things running along pretty strong. In summary, the FOMC left rates unchanged as expected. 2 more cuts coming likely in June and December. Warsh has been nominated for the Fed chair. So that will come later this year. Q3 productivity unrevised at 4.9, but that's the best reading in 2 years. Producer prices came in well above expectations and have resulted in core PCE and PCE figures being revised higher, or the expectations being revised higher, I should say. Trade balance wider than expected, but still that's kind of normalizing off of a very, very narrow number. Durable goods orders in above forecasts, with core capital goods posting their 5th straight monthly gain. Again, good continued spending and on the kind of industrial side of things. And then on the other side, consumer confidence, as I just ranted about for a while, but fell to 84.5, lowest in over a decade. And that labor market differential continues to unwind. Key data this week, supposedly, given the nature of the shutdown again, some of this is TBD, but we get JOLTS tomorrow, Tuesday. Challenger Gray job cuts and unemployment claims on Thursday. We get ADP payrolls. That'll be out regardless. Their private figure will be out. And then finally, we get non-farm payrolls and University of Michigan sentiment. I think is the preliminary reading on right? Oh, no, that'll be the final reading, I think, on Friday. Anyways, that's it for now. Thank you so much for joining us. Hope you have a great start to your week and to February. Thank you so much.